Hello and welcome to the first of our ACCA P2 Lecture recaps. This is a recap of our lecture on IAS 27. Remember, this really helps because when we go into the workings on consolidation, this is where they come from. So this tells you what's required under the standard, and that makes more sense whenever you're doing your workings. You'll be able to think, yes, IAS 27 says that I need to do this. So the first thing that we said is what's covered by this standard. Well, why is it needed? So it tells us why it's needed, and it's needed to enhance the relevance, reliability, and comparability of our group accounts. So that's why we have this standard. It also tells us when we need to consolidate. So when should we have a subsidiary? When do we need to bring them in? Also tells us how to deal with the change in the level of ownership. So say you've bought shares or you've sold shares, what is the correct treatment in those cases? Also, if you lose control, so if it's no longer a subsidiary, what do you do? Well, IAS 27 sets out the rules. And also then the disclosure requirements for your group accounts. So moving on then to definitions. In P2, definitions are crucial. You need to know the definitions in all of the standards that we look at because that will be your starting point for a question. So control, you may have to determine whether an entity is controlled or not. The definition of control in IAS 27 is the power to govern financial and operating policies to obtain economic benefit from those activities. So that's control. It defines a group as being the parent and all of their subsidiaries. A non-controlling interest is the equity in the subsidiary not controlled by the parent. Lastly, a subsidiary is an entity that is controlled by the parent. So we are already seeing that control is very important in IAS 27. So when do we consolidate? As I've just said, it's all about control. When do we acquire control of the subsidiary? And what is control? So control is going to be half of the voting rights. So owning half of the shares, having half of the voting rights, that's control. But not only that, you may not have half the voting rights, but you have, say, the power to govern policies. If you have the power to govern policies, that's control. If you have the power to appoint or remove a board majority, again, that's control even if you don't have half the voting rights. Or if you have a majority of the board votes, again, that's control even though you don't have half of the voting rights. If you own some convertible debt, well, you'll have to look at the management intention. What do they intend to do with that convertible debt? And the ability of them to convert. Can they actually convert that? If the subsidiary or the potential subsidiary is a different entity or in a different industry, there's no exemption from consolidation. You still have to consolidate them. There's no need to consolidate if the parent is a wholly owned subsidiary or if they're not listed. So if they're a wholly owned subsidiary or they're not a listed company, no need to consolidate. So IAS 27 sets out the procedure we need to undertake when we're consolidating. So we need to combine the financial statements. So that's what we're doing. They're adding them up like our guy there, combining the financial statements line by line. So that means we're adding together our assets, our liabilities, our income, and our expenses. So broadly speaking, that's what we'll be doing throughout the consolidation procedure. The purpose is to present the two sets of accounts as a single entity or more than two sets of accounts. What we need to do is eliminate the investment in the subsidiary in the parent's singular accounts and then just use the parent's equity when we're looking at the equity of the group. So the parent's equity is included only. When it comes to non-controlling interests, we need to remember that they get a share of the profit or loss each year. So also they will have a share of the assets and liabilities on the statement of financial position. So that will be our non-controlling interest at acquisition, plus the non-controlling interest share of profit since acquisition, and this is all shown in equity. And that's where you will see it when we go through the questions. So when you're going through the questions, you're calculating your non-controlling interest, you should be thinking, yes, IAS 27 says that it's the non-controlling interest at acquisition plus their share of the profit since then, and that needs to be shown in equity. We need to eliminate intragroup balances. We need to eliminate intragroup transactions because we're only interested in that group's dealings with outside entities. Dealings with between each other, between the parent and subsidiary, not interested. So we need to take those out. For example, we need to remove intergroup profit, we need to remove intergroup dividends, and we need to remove deferred tax, or that will have an implication on deferred tax. If they have the same reporting date, that's fine, but they should have the same reporting date under IAS 27 unless it's impracticable to do so. So if it's not practical to do so, you can have a different reporting date with the parent and the subsidiary, but the difference can't be any more than 3 months, so look out for that in questions. And they must have uniform accounting policies. Parents and subsidiaries must have uniform accounting policies. Loss of control then. So if you had a subsidiary, you did control it, you don't control it anymore. You've dropped it, like this guy here. Look out for if it's over 2 transactions. So 2 transactions to lose control. You need to see where they entered into at the same time, in effect making them 1 transaction. What's the overall commercial effect? When did they lose control? Does one transaction depend on the other? Again, could indicate 1 transaction. And if one transaction makes no sense without the other, again, that will all stem into your date of the loss of control. And we look at that in detail when we're looking at the sale of shares in a subsidiary. When you lose control, you need to de-recognise all of the assets of the subsidiary at their carrying amount. You need to take out the non-controlling interest. And then we need to recognise the fair value of the consideration and the fair value of any retained interest. They might go from a subsidiary into an associate. We need to recognise that. So we'll then treat them as an associate or an investment. So think back to this whenever we're going through the detailed workings on the loss of control. It all stems from IAS 27. Disclosures then, disclosure requirements under IAS 27, the nature of the relationship. So the nature of the relationship needs to be disclosed if the parent has less than 50% voting rights. So you need to say why then you've consolidated, why they're a subsidiary. If more than 50% is owned, you need to say why they're treated as an investment if they are. So if they're not treated as a subsidiary and you own more than 50%, why are you doing that? So why has there not been any control? If they have different reporting dates, you need to say why. If there's any restrictions on the subsidiary's entity or the subsidiary's ability to return loans to the parent, that's got to be disclosed. Or if the subsidiary has a lack of ability to pay dividends to the parent, that again needs to be disclosed as well. You also need a schedule in the changes of ownership. So if you're keeping control, you need to say, right, we sold some shares, but we're keeping control, and that needs to be disclosed. If you've lost control, you need to disclose the gain or the loss that you've made, and you need to disclose the line in which it's recognised in the statement of comprehensive income. So you're saying our gain or our loss was X amount, and it's contained in administrative expenses or wherever it's contained in the statement of comprehensive income. Also need to disclose if you're exempt from consolidating. You'll need to disclose how that exemption arises, a list of subsidiaries, and the method that's been used to account for those subsidiaries. So that was our first lecture, our introduction to group accounts.